Welcome to Topic 8, Equity. In this topic, we'll learn about the three main categories of equity in a company, namely shares, dividends, and reserve. I'll show you how to account for the issue of shares, declaration, and payment of dividend of shares. Companies that are permitted to exist by law in Australia business environment are such as the limited companies, unlimited companies, and no liability companies. When forming a company, application is lodged with ACCT. To raise funds from the public, a prospectus is issued. Prospectus is a document a company releases when issuing a new security, which tells potential investors about the investment. In administering a company, we have shareholders, board of directors, managing directors. Shareholders are owners, but administration rests with directors. Duties of the board of directors include protecting rights of shareholders, setting officials' salary, recommending and declaring dividends, authorizing long-term borrowing, additional share issues, and major capital projects. Now let's look at accounting for share issues. There are two types of shares, ordinary and preference shares. In this course, I will show you how we account for payment for shares. Firstly, shares can be payable in full on application. That means when investors send in the application form, they'll send in all the money. Or they could choose to pay on application and the remainder on allotment, which is like installment. Or we have another option, which is to pay on part payment on application and on installment, and another installment which is known as call. Now let's look at this example where Brazil Limited issues shares via a prospectus. And shares are payable in full on application. That means all the monies have to be sent in together with application. So money will receive on 30th of September for 100,000 shares at $10 each. I'm going to show you the first journal entry to account for this transaction. So when money is received, we can't use the money yet. The money will go into the cash trust account, which is similar to an asset account. Then we credit our application account. Application is a liability account. Why is it a liability? Because we have received the money, however, we haven't issued shares to the investor yet. Therefore, we do have the present obligation to perform the service, in this case, to issue shares. So remember, cash trust account is a new account for us to consider, as well as the application account. Cash trust is similar to an asset account. Application is a liability account. Next, when the shares are allotted, application money becomes available for use. This is where shares recognized. So we need to firstly transfer money out from the cash trust account into our cash at bank account. To do so, we debit cash at bank, credit cash trust account. Remember, we previously debited cash trust account, so we need to credit the cash trust account to transfer the application money into the general cash account, so the company can now use the money. Since we have issued the shareholders with the shares, we need to show a reduce in liability by debiting application account. So we debit application account and credit share capital to recognize the share capital. Remember, cash trust is an asset account, application is a liability account. It is common for a company to receive more share applications than the number of shares that are called for. For example, if the company calls for 150,000 shares, but 180,000 applications were received. When that's the case, excess application money must be refunded to unsuccessful applicants. To do so, we should debit application account. Remember, application is a liability account. And credit the cash trust account, because the cash trust account has previously been debited, so the money will need to be credited from the cash trust account. And by debiting the application account, we're actually reducing our liability to show the refund of excess application money to unsuccessful applicants. We have considered application with full payment. Now let's look at installments. On 15th of September, Brazil Limited decided to issue 100,000 shares payable in 3 installments. The first installment being $4 on application. That means money must be sent in together with the application form. $3 is payable on 15th of October. This is similar to an accounts receivable, which is called allotment account. And the remaining $3 is payable on 1st of December. This will be a future call. Future call is again similar to an accounts receivable. When money is received from the application, cash trust is debited and we credit the application account. Remember, the application account is a liability account. Cash trust is similar to cash at bank. So this is to show a receipt of cash of $4 per share on a total of 100,000 shares. Then we need to transfer the money from cash trust account into our cash at bank. To do so, we debit cash at bank, 400,000, and credit the cash trust account. Something is missing. Remember, we must also include the date. We have just looked at the entries that we created to show transfer of cash at bank of application money, where we debited cash at bank, 400,000, and credited cash trust. We did that so that the money in the cash trust account could now be transferred into the cash at bank, so the company can now use the money. Remember that cash trust is an asset account. So when shares are allotted and money is due, we will need to create an entry to show a reduce in our application account. Remember, application is a liability account. So once we have issued shares to the shareholders, we can then recognize the share capital. To do so, we need to show a reduce in liability because we have already issued shares. So to show a reduce in liability, we debit application account, which is the liability account, and we credit share capital to recognize the capital. Then we'll look at a new account, which is allotment account. Allotment account is similar to an accounts receivable. So we know that we are yet to receive the 300,000, but we will receive that in the future. This is the second installment. So since that is an accounts receivable account, we debit allotment to show an increase in accounts receivable and credit the share capital. We must also include dates. Remember, we previously created the allotment account. Now, finally, money is being received on 15th of October. We need to show an increase in cash at bank by 300,000 and credit allotment account. Remember, allotment account is very much like an accounts receivable. Since money has been received on allotment, so we need to reduce the allotment account by crediting this account. Then we need to look at amounts due on calls and receipt. Call account is a new account for us to consider. Again, call is like an accounts receivable. So when the company made a call, we'll need to debit the call account. In here, the company actually made a call for 100,000 shares at $3 per share, therefore a total of 300,000 share capital. So we debit calls account and credit share capital. On 1st of December, that's money we received on call. So we need to increase the cash at bank by 285,000 and credit the call account since that money has been received, so we need to reduce the accounts receivable. However, you might wonder, we call for 300,000 share capital, however, we only received 285. That means that 5,000 shares have not been received. So what are we going to do with these shares capital that we call for but haven't been received? Earlier, the company made a call for 100,000 shares at $3 each. However, the company never received all the money that they called for. They only received 95,000 shares at $3 each. So we need to show these. This is also known as call in arrears. So the unpaid calls of 5,000 at $3 of a total of 15,000 has never been received. So it needs to be minus from the share capital. Here I'm showing you a partial balance sheet. Please note that if there is any formation costs such as legal fees, accounting fees, these must be expensed. Any share issue costs, such as stamp duty, must be treated as deduction from equity. Sometimes, company might decide to provide return to shareholders without any cash outlay. This can be done through issuing bonus share. When the company issue bonus share, that means the shareholders will receive more shares. By assuming the bonus share issue of 60,000 is declared and paid out of general reserve, the accounting entries will be general reserve debited by 60,000, share capital credited by 60,000. Dividends are distribution of cash and other assets or shares. It must not be paid unless assets exceed liabilities. Now, directors determine if dividend is payable and fixed amount, payment time, and payment method. The journal entries that we need when dividend is declared. Final dividend, we would do debit retained earnings, credit final dividend payable. Because dividend has not been paid yet, therefore it's a liability. So we need to show an increase by crediting final dividend payable. When final dividend is finally paid, we debit final dividend payable to show a reduce of our liability and show cash going out by crediting cash at bank of 80,000. This is just an example. Now let's look at reserve. Reserve are those items of equity other than capital contributed by owners. We have examples such as revaluation surplus and general reserve. To create reserve from profits, we debit retained earnings. By reducing retained earnings, we can then credit reserve to show an increase in reserve. Please note that when we create reserve account, it doesn't mean that physically there is money in the reserve account, because reserve is purely a book entry. So if we debit reserve and credit retained earnings, that means that we're transferring reserve into the profit account or retained earnings. Let's do a quick recap on topic 8. There's several new accounts for us to consider. First, cash trust account, which is an asset account. When application money is received, the money will go into the cash trust account because the money cannot be used by the company yet. The reason being, the company hasn't issued shares to the investors, so they do have the liability to do so because they have received the money. So we need to create a new account, which is an application account. Application is a liability account, so we need to credit the application account to show an increase in liability account. For share issues, we can either receive money in full or by installment. Allotment is very much like an accounts receivable. Okay, so when the company debit an allotment account, we know that we're going to receive the money in the future. Another type of installment is called call. So if a company make a call, the company will receive the money in the future. So dates are very important. If we do have enough money in the retained earnings, the company can then declare and pay dividends to their shareholders. We study about reserves. Remember that reserve is just a book entry. So physically, there is no money sitting in this account. I know that there's so much for us to take in this topic. However, I know that you're going to do very well.